Hello everyone, I'm back with a new video. We just wrapped up October and all three major indexes finished the month with strong gains. The tech-heavy Nasdaq even notched its 7th straight winning month, a very impressive run. Fresh earnings from the Magnificent Seven reignited optimism around sustained growth in mega-cap tech companies, easing worries about excessive AI spending. On top of that, we had encouraging developments on the US-China trade front and another rate cut from the Federal Reserve. All of these factors have helped to push the market higher. While many analysts are calling for a top, price action continues to print higher highs. As we move into November, historically a strong period, the big question is, will the market surprise us with a sudden pullback or will it continue to climb higher? And by the way, I have added shares of a company last week. Do stay till the end to find out which one. Alright, so all three major indexes scored their third straight week of gains last week as investors digested a week of big tech earnings and the Federal Reserve's decision to lower rates earlier in the week. Some of last week's big winners include e-commerce giant Amazon, social media giant Alphabet, and iPhone maker Apple. All three of them reported stronger than expected results and upbeat guidance, which reassured investors about the trajectory of big tech. On a side note, Nvidia, though did not report earnings, saw its share price also gain for the week after hitting a valuation of 5 trillion market cap, the first company to reach this impressive milestone. In addition, Netflix popped as well after it announced a 10-for-1 stock split. The losers of the week were Meta and Microsoft as they both projected big AI expenses, but honestly, personally, I think their earnings were pretty solid too. Next, the US stock market saw the Federal Reserve cut interest rates by 25 basis points last week. This decision reflected the central bank's concerns about elevated unemployment. While inflation remains somewhat elevated, the Fed felt that they need to address the downside risk to employment. While lower interest rates is often seen as a positive news for companies because borrowing cost becomes cheaper and companies can innovate, expand, invest and hire. The Fed also announced that it would stop shrinking its balance sheet, a strategy known as quantitative tightening or QT in short, by 1st of December. This is good news for companies and the stock market because it stops removing liquidity from the system. It often signals more liquidity entering the market and improved credit conditions. And last of all, President Trump and President Xi had reached a trade truce during a high-stakes meeting in South Korea last Thursday. This has de-escalated a dispute over rare earth elements that had threatened to push the two largest economies into a full-blown trade war. In the upcoming week, we will continue to get the third quarter earnings reports. Investors can expect a solid lineup of high-flying stocks, including Palantir, AMD, ARM, Qualcomm, Uber, and Shopify. On the side note, Tesla will be hosting a crucial annual shareholder meeting on Thursday, 6 November. In focus are the votes for CEO Elon Musk's new $1 trillion compensation plan. Musk has threatened that he could walk away from his role as CEO if shareholders do not approve the pay package. During its recent earnings call, Musk claimed that he needs to have at least a strong influence over Tesla before he feels comfortable scaling the Optimus humanoid robot. Musk already is currently Tesla's top shareholder with about 15% stake. And other key things to watch in the upcoming week include the ADP employment change report on Wednesday and the ongoing government shutdown. With the shutdown still unresolved, Wall Street may need to rely on the weekly ADP jobs data for clues and insights on the labour market, since we could once again miss the monthly non-farm payrolls report. It is also worth noting that a resolution to the shutdown could act as a short-term catalyst and potentially pushing the stock market even higher. Let's now move over to the technical analysis segment. As always, we shall look at the broader market first, SPY. The chart looks straightforward as SPY has been moving along this green uptrend line for the past 4 to 5 months. So long as it continues to do so, we will see more record highs from now till year end. In terms of the downside, it would be good if we can have a healthy pullback this or next week before another leg up. If we do get a retracement, I think the odds of the two gap ups getting filled would be pretty high. This means we could see SPY falling back to the first Fibonacci level at around 672. This 672 level is a huge support level to watch because it's where the bottom gap, the Fibonacci level and the green uptrend line converge, forming a triple support. In addition, it used to be a level of resistance which before we had that breakout. So in short, if the market does pull back in the short term, watch this support level closely. If SPY bounces up, then we are likely to push higher to another record high. But if SPY falls below it, then things might be a little bearish. But that's when I might be shopping and hunting for discounted shares of strong companies. Moving over to Apple, the analysis for Apple's chart is a little similar to SPY. Basically, Apple is also on this nice uptrend marked by the green trend line. From the current price point, if Apple pulls back, just like SPY, watch that first Fibonacci retracement level at around 259. Again, similar to SPY, this level used to be a level of resistance before we had that breakout, and it has now turned into a support level. Together with the green uptrend line, this is also a triple support level, which means if the bullish momentum is still intact, any retracement should not go below this 259 level. If Apple retraces and bounces off this level, it's actually pretty bullish. Or better still, if Apple doesn't even go near this level before climbing again, then the bullish momentum is actually very strong and investors can expect more all-time highs in the uncharted territory. On the other hand, if this 259 level breaks, I think minimally we will feel the gap between 253 and 255. Below this gap, watch the 50 moving average at 248. If Apple closes below this moving average, then we can say that Apple's trend has turned bearish. Let's now move over to Tesla. Before that, just a quick one, I'm about 50 subscribers away from hitting 3,000. So if you haven't subscribed yet, do consider doing so and help me hit this little milestone soon. Okay, back to the chart. Tesla is actually going nowhere as it consolidates between around 410 to 470. I know it is a huge range, but that's Tesla. It can move 20 to 30 points up and down in a single trading session. Let's talk about the upside first. Tesla seems to have faced a bit of resistance at around high 460s and the 470 level. So if it somehow can close above 470, I think the momentum could easily bring Tesla into the 480s range. From there, if there is nothing too negative coming from the company or in the macro environment, there is a very high probability that we could see new all-time high in Tesla. And of course, at all-time high, it's called uncharted territory where most people would just let their winners run, which means 490s and even the big 500 could be in sight before you know it. On the flip side, if institutions start to dump Tesla shares for whichever reasons, watch for the bottom of the consolidation zone at around 410. Interestingly, this 410 level is also where the 50 moving average is. Therefore, if this double support level breaks, don't blink your eyes because Tesla could easily fall below 400 and complete the gap fill. This gap is between 396 and 402. From here, the longer we stay below 400 and the 50 moving average, the more bearish it gets. I wouldn't even be surprised if it starts falling below 372, where the 50% Fibonacci level sits. Meanwhile, just a gentle reminder, there is a Tesla shareholder meeting coming up on 6 November Thursday. It is difficult to predict if this event could move the share price drastically or not. So it's better to adopt a wait-and-see approach if one is trading for the short term, because the share price can really swing either way. Okay, jumping over to Google. Since breaking out of the blue downtrend channel, Google has been on a little parabolic run, rising more than 10% in about 2 weeks. But all good things will come to an end, or at least a pause, as we saw 2 red candles towards the end of last week. If the pullback continues this week, I would expect the 23.6 Fibonacci level at around 275 to be tested. If Google closes below this level, I actually think the bears might just bring it to the gap between 261 and 264. To be honest with you, if Google pulls back from the current price of 280 to 260 range, there's nothing to be worried about. The key support levels that I am watching are actually the 61.8 Fibonacci level at 250 and the 50 moving average at around 244. Just to add, the latter sits near to the blue downtrend channel, so if somehow Google drops below 244, it would have gone back into the downtrend channel, and that is obviously bearish. For that to happen in the short term, I think it's gonna take something really negative to push the price down to that level, and I think the odds are pretty low. Alright, on the other hand, if Google can bounce off the gap or either of the Fibonacci support levels, that's a very positive sign because that will help to cool off any overbought indicators, giving the share price more room to go higher. Let's now have a look at Meta. Well, I don't think you need me to tell you that Meta is looking very bearish. It had this super huge gap down last Thursday and basically sliced through all the various support levels like a tofu. More importantly, it fell below the important 200 moving average, something that we have not seen since 1st of May this year. For Meta to stop its rot or for the bulls to see some light, it needs to quickly reclaim the 200 moving average. The longer it stays below it, the more bearish it gets. But here's one saving grace, and that is the bottom of this purple downtrend channel seems to be holding up, at least for now. If it continues to hold, then there is a chance that Meta might bounce in the near term, especially when the RSI is hitting oversold area. That being said, if Meta somehow breaks below the downtrend channel, then we need to be mentally prepared that the gap between 606 and 620 could act as a magnet to pull the share price further down. In terms of the bullish thesis, as mentioned earlier, Meta needs to go above the 200 moving average quickly, but that's only the first baby step to reverse the bearish trend. We need to see Meta going above the purple channel again. If we can get a few candles above the channel, then there is a chance that Meta could slowly recover and grind higher to fill the gap down. By the way, I sold a put option on Meta last week. Do check out my options trading segment for more information. Moving on, let's check out Microsoft's chart. Well, Microsoft seems to be loving the 50 moving average a lot. At one point, it had a solid breakout from the 50 moving average, but look at where it is now, back to the moving average. Anyway, Microsoft is swaying towards the bearish camp, which I think is pretty obvious, right? We had 5 consecutive red candles and sort of a bearish double top pattern. The MACD is also looking quite dangerous as it seems to be on the verge of having a bearish crossover. If the bearish crossover happens this week and if Microsoft closes below the 50 moving average at around 514, I would say the momentum is getting more bearish. That's when I would expect Microsoft to fall towards the low 500s range. And if somehow Microsoft goes below the low 500s range in the next few weeks, pay very special attention to the recent low of 492. If this breaks, then the double top pattern would have played out, which will then unlock a lot more downside, probably towards the 470s range. On the other hand, if Microsoft can continue to stay above the 50 moving average, then things don't look that bad. But for us to call Microsoft a little bullish, it needs to close back above the 23.6 Fibonacci level at around 523 with good volume. Okay, let's now check out Nvidia's chart. I must say Nvidia is an absolute beast as it became the first company to hit $5 trillion in market cap. Remember months ago, I talked about stepping up Nvidia shares below 100. Based on the current price, one would have doubled his or her money. Anyway, since we hit an all-time high of 212, Nvidia has a little retracement towards the end of last week. That's pretty normal and healthy. If the pullback continues this week, don't be alarmed if the huge 200 level gets breached. Below 200, I personally will watch 188 and 182 levels. 188 is because that's where the so-called pivotal 50% Fibonacci level sits. If that breaks, then naturally the share price will likely continue to fall towards 182. This 182 level is very critical in my opinion. Other than being the important 61.8 Fibonacci level, it is also where the 50 moving average is. On top of this, that blue support line is also sitting near 182, which means this is what I would call a triple support level. If the overall bullish momentum is still intact, this level should hold by right. If it ever drops to this level, I might consider selling put options. But then again, such strong support level is a double-edged sword. What it means is that if it breaks, then the downside could be massive. That's when I think we could see Nvidia share price falling below 175. Alright, moving over to the options trading segment. There are 6 trades to update in this video. As usual, I have summarized them on screen. The first trade is a new cash secure put on Google that was sold on 21st October. The strike price is $2.15 and the contract will expire on 28 November. I chose to sell this put option for my favorite reason, and that is overreaction by the market. So what happened on 21st October was that OpenAI announced its very own AI-powered web browser called ChatGPT Atlas. The browser is designed to integrate the ChatGPT experience directly into web browsing and will be challenging Google Chrome's market dominance. When the report came out, Google's share price dropped as much as 4.6% during intraday, and so I quickly stepped in to sell a put option, which is a bullish move, because I was of the view that the market has clearly overreacted. Well, by the end of the day, Google recovered half of its losses and was down about 2.4%. Fast forward till today, Google has gained more than 10% since that day, 21st October. As a result, this trade is currently sitting at about 85% profit in just less than 2 weeks. Next up, it is this new cash secure put on Meta, which was sold on 31st October. The strike price is $5.50 and the contract will expire on 5th December. The reason for selling this put option is the same. The market has overreacted to Meta's earnings. As you can see on the screen, Meta had a huge gap down and plunged 11% after it reported its earnings. The weakness went on for another day as it fell by another 2.7%. On that day, which was 31st October, I decided to step in to sell the put option because I was of the view that the earnings results were decent and the market had overreacted to the downside. Though the share price might look weak at the moment, I believe it will eventually bounce back up. Okay, moving on, the third trade to update is this new cash secure put on Tesla, which was also sold on 31st October. It has a strike price of $3.25 and the contract expires on 5th December as well. I opened this position because Tesla has been consolidating sideways since September. Even after the latest earnings, the stock held its ground instead of selling off. In addition, with the MACD on the verge of having a bullish crossover, I think there is a low probability that the share price suddenly drops below my $3.25 strike price. On top of that, there are multiple support levels above my strike price, including the 50 and 200 moving averages, as well as the critical 61.8 Fibonacci retracement level. Finally, the last 3 trades to update are these contracts that have expired. I will not go into the details because I have shared them all in my past videos. Anyway, both Nvidia and Tesla closed above the strike prices on their expiration dates, and the total profit for these 3 trades combined is around $600 which is equivalent to about 780 Singapore dollars. It's not that bad as an extra income. Alright, last week was a pretty eventful one. Overall, investor sentiment remained bullish thanks to strong gains across tech and semiconductor stocks, which were fueled by optimism around the future of AI. With the FOMC meeting, mega cap earnings and the US-China trade talks behind us, it feels like there's not much that can stop the boost right now. Since the tariff-driven sell-off in April, the market has much higher, and along the way, lots of people, including analysts, investors, YouTubers, have been calling the top, but yet the market continues to make new record highs. This has taught us something very important. In a bull market, opinions don't matter, the trend does. Like I always say, don't fight the trend until it bends. If you are waiting for the crash before investing, the market isn't waiting for you, it's already moving. Therefore, it is important to stay invested at all times. That said, this doesn't mean you need to go all in at the current elevated valuations. It is perfectly fine to size in slowly, stay cautious, or hold some cash on the sidelines. The key message is to have some exposure so you can ride the upside and add during healthy pullbacks. And that is exactly what I have been doing. I stepped in during April's sell-off, continued to nibble in during dips and pullbacks. For example, last week when Meta plunged more than 10% in a single day, I picked up a few shares again. Okay, so in moments like this, the market leaves behind those waiting for perfect dip or betting on the inevitable crash. Remember this, opinions are cheap, but price action is the truth. If the price action is telling you a story, pay attention. With that being said, when the trend eventually shifts, we will have to shift with it. But until then, staying aligned with the current market strength isn't just a strategy, it is a mindset. Don't fight the market and the trend. Don't overthink why the market shouldn't be going up because valuations are elevated. There is no need to rationalize every single thing. And valuations aside, the current market is climbing against a supportive backdrop. Easing macro pressures and trade wars, a rate cutting cycle, solid companies' earnings, the AI boom, and rising investors' risk appetite. When you layer all of this together, it actually makes sense why equities are grinding higher and higher. Alright, sharing one interesting seasonal trend before we wrap up this video. Going back to 1950, November is historically the best month for the S&P 500, averaging a 1.8% gain, and history suggests that we may still have room to go up. Since 1950, whenever the S&P 500 gained at least 15% in the first 10 months of the year, it finished higher in the last 2 months almost every single time, except for one occasion. Alright, at the moment more bears are throwing in the towel and bulls are advising not to bet against this trend. But one day, the music will stop. That's just how the stock market works. However, if you are constantly waiting for the perfect dip and crash, you will risk missing the entire dance. As for me, I'm just going to keep dancing until the music stops. Okay, that's all I have for this video. Do help me with the YouTube algorithm if you found my content useful by liking, subscribing and commenting something below. Thank you very much.